Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter. I'm going to show you what people are sharing on social media. It's generally related to three topics: wealth building, financial topics, and commodities. I know a lot of people are talking about uranium as it's gone up quite a bit here recently, and I'll also dive a little bit further into the uranium market. Give you guys a big picture view, kind of how I chart things, not saying that I'm the best charter ever, but I do things from a bigger, longer term perspective than, say, some of the short term stuff that people try to time. So let's dive in here. Let's see what's going on in the markets. I'll give you my financial opinions. And don't forget, we've got a 5 p.m. Sunday question and answer session coming up tomorrow. Let's dive in here. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, if you want to dive deeper into these sectors and companies. So Warren Pi says a U.S. recession has never started with the deficit this high. No recession has ever began with a deficit this large. And that is speaking to the fiscal deficits that the government's running. This could be propping up the markets. And I know that the yields are starting to come and uninvert to some degree. That's generally when we have a slowdown, but here's the thing. This is what makes it very, very difficult to predict. A lot of people say that when the yield curve uninverts, at some point we get a slowdown or recession, and the yield curve has um, been a precursor to a slowdown in almost every instance. The the yield curve inverted from what I would consider to be synthetic money coming into the system, the stimulus money. It inverted the yield curve because they raised rates real quick. It slowed down the housing market, but the housing market has generally been the pacing factor in the slowdowns historically. Because generally we go into a hyper supply phase and things slow down. The fiscal spending that we're seeing here can definitely elevate any type of slowdown that the market or economy, well, it's going to be the market sees. Now, here's another thing. That yield curve was inverted by synthetic measures. It was not driven by the real estate cycle. So the size of this slowdown, if there even is one, is unknown. We don't know. And Warren is just saying a U.S. recession's never started with deficits this high. So it makes everything very difficult to try to project on the short term, is what I'll say. Coming on down, two observations regarding the latest model data heading into the long, dangerous holiday weekend. This will be a two-hit Arctic blast with a primary peak on January 16th, followed by a reinforcing shot peaking January 20th. The final week of January now looks warmer than normal. So this is talking mainly about natural gas and the weather that is potentially coming. This is the consensus model gas weighted degree day outlook. And this is over normal. We've got a good chunk of January that's over normal, and then a little bit under January later on. That's a little bit below normal. Just an FYI. I've been watching a lot on natural gas as these LNG terminals are coming up 2024, 2025. There's a lot being built. And nat gas from where we're coming from a level, from a ratio perspective, that is incredibly cheap against a lot of other assets. So nat gas is something I'm highly interested in, and I'm interested in energy service companies because I think we are probably pretty close to bottoming. So speaking of energy service, no rush to jumpstart activity so far in the new year, but U.S. horizontal rig count, we've come on up and it's dipped a little bit here recently. A lot of the insiders think that we are bottoming here at some point, and we're going to see a lot of things start to pick up Q2 of 2024. That's kind of where their heads are at. That's kind of where mine's at. Remember, the markets are forward looking. We're in Q1, and we're halfway through January here. So it's probably going to bottom here at any second for a lot of the drilling companies and stuff like that. And I'm getting more bullish on not just natural gas, but also the energy service companies. Total U.S. rig counts were down 2 in oil, -1 in gas, and miscellaneous were up 1. So total rigs were down 156 year over year. And another thing that we look at, and if you guys have gone through some of the training that we've done on technical analysis, is, let me yank this down just a little bit. There we go. Is we notice on the consolidations we get 3 humps: hump 1, hump 2, hump 3. And then you've got a falling wedge basically that's occurring in your Baker Hughes oil rig count. You can see crude oil production per rig. Per rig, we are getting more efficient as we come on up per rig. I think they're drilling a lot farther underground, and they're doing horizontals that are going to go up to, I think, 3 to 5 miles is what I was listening to. And then you can also see the U.S. Baker Hughes natural gas rig count on the bottom here. And you can see another falling wedge. You've got one distinct hump, a second one, and then the third is down here. You can draw this down into a corner. That is your apex. We had a false breakout down, and we've been moving sideways over time. I do think that this will eventually bottom and work its way on up with time. With time. So that's what I'm seeing. I'm seeing those 3 humps, falling wedges pulling on back with the rig count. Every single gap up on open, USO was sold down. Someone has clearly seized control of the oil paper market. They gap it up and then they sell it off. Gap it up, sell it off. Gap it up, sell it off. So someone is adding a lot of selling pressure throughout the market. It gaps up and then it gets sold throughout the day. Sometimes that's a way when they try to sell something, they gap it up. Now, in some of the companies, I'm seeing the exact opposite. They gap it down in the morning, try to get everybody scared to sell positions, and then someone's accumulating. So on the equities, they've been gapping down and then working its way on up throughout the day. Gapping down, working its way on up in a lot of different individual stocks that I've been watching. These are techniques that the big boys do play, and it's something to be cognizant about. Okay, coming down. NXE is up almost 10%. And I know a lot of people are getting real excited about uranium. There's a couple of things I want to talk about. I've got this one, NXE, that somebody had posted. One thing I wanted to talk about is look to your left and where the volumes of shares are traded. This is where the volume of shares traded. When you start to get above that volume, you've got empty air. Empty air is a fly zone. We call it the fly zone where things start to move up more dramatically. So we're entering that fly zone on the right-hand side here because there's no volume above us. And this isn't just NXE. There's a couple of companies, and I can show you some more here. Here's another one, URNJ. On the right-hand side is the volume of shares traded. And what happens is you hit resistance where all this volume's at. You hit resistance, it sells off. You hit resistance, sells off. Hit resistance. You usually get the low points to come on up. And then when we break the trend line, we broke it here, a pretty good volume on the downside here. You can see the volume here, but this is where the majority of shares are traded. Once you get above this volume area, it's a fly zone, and you can see us flying up to the upside and on good volume down here. So these are things that you can look at when you do your charting, and it is indicators that there isn't much overhead resistance left, and we're ready to go into the fly zone. I'm going to jump into something that how I chart, and I'll just make it a little bit bigger here. So this is kind of how I do things here. And I just took this off. 1 second, guys. One second. I'm gonna have to shrink this up just a little bit there. Okay, there we go. I just had to readjust there. Okay, so this is deep yellow. Deep yellow is one of my larger holdings, and I just wanted to share this with you guys. Deep yellow is going through the bottoming phase here. So stage 4 decline. We come on down. We go to a basing period. I call that stage 1. You can see kind of this double bottom. We got a couple of resistance lines here. We broke out, we did a retest, and now what I think we're doing is we're entering stage two. Stage two is an area where we really start to move on up, and then we'll eventually hit stage three, where we'll probably top off and do something like that, wherever that is. And I'm not saying it's there, I'm just drawing it there because it's easy to draw. So to gain kind of the perspective on this developer here, just to use as an example, stage four decline, stage one is your basing pattern, and we've broken out, did a retest. This is another great buying opportunity there, which on the website we took full advantage of. And then we are starting to work our way on up. So that's kind of the big picture view of where I think we are at. I think that we've got a long way to go in stage two for those who are patient investors. Now, I'm not stating that this is just going to go straight up. I'm going to tell you that I don't necessarily know the path. The path, we could do something like this, however it goes. But that's where we're at in the big picture view. I just wanted to touch on that. Elite says, I think of all the people who sold their positions when certain Twitter X accounts, who I won't name, pushed bearish false info, possibly ruining their chances to upgrade their family's financial position. I couldn't do that to anyone. And I don't know if these people are doing it on purpose. I don't really know. I think maybe what they did is they saw the yield curve invert. When the yield curve uninverts, that generally what does well is gold and silver. And I'll just say this, it's incredibly hard to nail this cycle because there's been a lot of synthetic things that have occurred in this cycle. Synthetic being stimulus money, interest rates, quantitative easing, quantitative tightening, messing around with the money supply. I don't know if there's a way that they can manipulate the markets more than what they have. So it's made the water very muddy. You can't see through it. And a lot of things have occurred in the markets that are that we haven't seen in history. So you can't really look back at history and be like, this is what it is, 100%. It's got me, shook in the short term because I can look at this stuff and I'm like, well, yield curves inverted from stimulus money, but the market historically has fallen from weakness in the market. But this isn't falling from weakness in the market. It's from interest rates brought to a level from synthetic inflation. And the underlying economy in certain sectors are as bullish as you can get, real estate and housing, which is also the most important sector for the real estate cycle and business cycle. So who's going to be right here in the short term? I don't know. And that's where I just stick with my positions if everything looks good and stay long. That's what I do. It doesn't mean that's necessarily what other people should do. And maybe that's what people thought that were of other Twitter accounts. Here it says it may not last, but it will be nice while it does. Alberta natural gas prices. Big move from January 1st. This is $1.75 to basically doubling to $3.50. And hopefully some of my natural gas producers get a little, maybe they hedge a little bit in here, part of their production that's up right now. Hedge a little bit. But that's a big move in natural gas that we've seen up in Alberta. Uranium, it says Finding Finance, which is me, have been saying 150 a pound is unrealistically low a target from the very beginning. Adjusting 2007 price to money supply gives us a $420 a barrel value. Note, most other assets like gold and Dow Jones also 3x'd since 2007. So I know a lot of people, they talk about round numbers, 100, 150. Oh, I think uranium's going to go to 100 and I'm going to reduce my stake when uranium gets to $100 a pound. That's not how I operate. I look at history. We can look at, here's UX1. This is your uranium price. It's up at 104 right now. There's that big gap where we could really start to gap up. I know people get afraid whenever things go vertical like this. This is generally a very your risk goes up as things go vertical. And I know people get very drawn to the sector because of the price movement, and they think that this trend of going vertical will continue and last forever. What I'm going to say is, I don't know, but I think we're going to go higher. That's my guess. Now, what I do and how I look at this is I start to compare it and price it in other asset classes. So let's do uranium divided by gold. And what this is this is an accounting factor. Think of it as a inflation adjusted price. And when I look at this, I think we've got a long way to go higher. And if I were to price this, real quickly, just to show you guys the green lines where we're at. So if the price were to go back to 2007, that means that uranium would outperform gold by a factor of 4.3 times. So if we were to go back to this ratio up here, the ratio is at 0.2. 0.2. Do you guys understand what that means in terms of pricing? So if we were to price back in 2007 the same ratio today, that price would be 2,050 times 0.2, which is $410. So that is the area that the psychological threshold is kind of at, is about $420. Now, am I saying that it's going to go to $420? I don't know. That might be the case. It might not be the case. We may blow 420 out of this world, as the two previous historical bull markets have had inventory levels. If inventory levels really start to dry up and there's a gap between uranium inventory and production, and there's a deficit that is quite large, people could panic. Where's the price going to go? I don't know. I don't know what that price with a panic included in it will be. Obviously, we've got these markers in history where the price has gone up before, but this time it could be a little bit different than the previous times. We don't have the inventory levels like we did last time. And maybe people start to panic, not like last time, but actually panic. Then I don't know what the price will go to, where you actually start to destroy demand. And if there is no mechanism to destroy demand because the inelasticity, which means people are going to continue to bid until they get it, I don't know where that goes. I just know that it's a lot higher than where we are at today. Now, if you start pricing a lot of these, like URA, the ETF, against uranium, we are at low levels, the same level that it was in April of 2020. The pricing of the ETF and the equities are off the chart cheap in relationship to the physical metal futures pricing. Now, people are going to ask, well, why is that the case? I don't know if the commodity bull market has really started. I mean, we are cheap across the board for commodity companies. Maybe there's a crash coming and people think that there's going to be a crash before, and maybe they want to load up on the equities when that crash comes. I don't really know. I don't think anyone knows. But we are incredibly cheap still at this time in history. Here's Grady. He says, brilliant setup here. This is silver. The mother of all legit looking probable cup and handles is still stuck in there. And I know people are getting frustrated with silver. They're saying it's not going to take off, blah, 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 blah. First, it had a picture perfect quintuple support backtest to pink handle arc, black line, gray line, blue line plus fib 62%. That is stylish. So it's 62% from the peak here is the pullback. It's a fib retracement level. Then it formed a huge bullish blue expanding falling wedge as backtest pattern. We're coming up on the chalk and money flows. And we're just kind of waiting for the right market conditions. If yields start to come back, especially the shorter end of the curve, and we uninvert, this is going to rocket here, guys. It's going to rocket. Now, it's not about winning on every single piece of your investments. It's not about winning on your whole portfolio, although we try to do that. But some of the market conditions will push some assets down while other assets go ballistic. It's about having that large symmetry in your portfolio. having the asymmetric bets. So having a bunch of cheap silver companies at the same time that you've got uranium in the portfolio, at the same time that you've got oil, exploration, production, and energy service, maybe some steel, iron ore companies, base metal, copper companies, whatever it is, it's going to balance the portfolio. And the symmetry is going to carry the portfolio to the upside. Symmetry means that the most you can lose on a position is 100% of that position, but you can gain far more than 100% to the upside. I've got positions that are up 10 to 20 times my money, and I've got a good 10 plus positions now that are in that type of position. Well, I'd have to add them all up. It's probably around 10 or more. And they're mainly located in uranium and oil and gas and energy service, depending on the companies. So probably over 10, if I can guess, of 10 baggers since 2020. And that's going to carry the portfolio up. That is what's going to carry. And right now, I'm entering some of these types of companies because they're down so much. Everybody hates them. Everybody loves them when they go up. They try to chase price, just like uranium right now, and the sentiment is going probably to overly bullish. But then these other ones where people and the sentiment are not at, you just quietly accumulate when no one's looking. You just kind of turn around and accumulate, and everybody else is just looking, and chasing shiny objects that are moving up. Here's uranium. Congrats to all of those who accrued while all the big names were grinding around the 200 weekly EMA. We've got URANIUM, URA, Kazatomprom, DNN on the 200 moving average. If you accumulated down there, that's great. You went opposite of the sentiment. Good job. What is a good age to have your house fully paid off? If I never make an extra payment, I'll have my mortgage paid off in 14 years. I'm 38. My goal is to have my home paid off by 50, but I don't think 52 is that bad. Note, I have a 2.625 interest rate. Mine's 2.75. I probably refinanced the exact time he did, except they paid for my finance and I got it done for free. So my opinion is vastly different than other people's opinions. What I'm doing is I'm not going to pay off my mortgage. I really don't care about it. I have a 2.75. It's a really low payment. What I'm doing is I'm putting all my money into big dividend paying stocks and I'm cash flowing off the dividends. I can pay my house off today if I wanted to. I could easily do that, but I just don't see the value in doing it with an interest rate that is lower than the inflation rate, which means that when I borrowed the money, they gave me more purchasing power in dollars of that loan than what I'm going to pay back in inflation adjusted dollars. So the quicker I pay it off, the more purchasing power I give to them. So what I'm doing is I'm taking the money, I'm investing it, I'm using that money to cash flow, and then I'm using the cash flow to pay off the interest payments, well, not interest payments, but the payments on the mortgage, and then all my living expenses and everything else. That's how I'm handling it. Uranium in 2007, some explorers in good jurisdiction with no resource reserves were trading at 500 million market cap. Plenty of explorers trading at below 10 million market cap right now. Obviously, very high risk plays. Always do your own research. So, agreed. There was a bunch of companies that were trading at 500 million market cap in 2007. In 2007, we were at a fraction of the money supply, too. I also think that we could potentially have a larger shift in capital flows to coming up in the 2020s than what we did in 2007 based off of a variety of charts that I look at. I think that we could even outperform the 1970s, maybe. And I'll show you the chart when I'm talking about that because I posted it up here. Bulls will likely want to see these two areas hold steady in the coming days and weeks, the Russell 2000 and the dollar index. Generally, dollar index goes down with interest rates, and generally, Russell goes up with a declining interest rate environment. We'll see if that actually continues. Now, this is the chart I was talking about. I said, what exactly does this ratio chart mean? I want to hear from you. I have my theories here. I'm going to go over what my theories are. So let me shrink this down. So this is a ratio chart. This ratio chart is the producer price index divided by the consumer price index. Ever since the late 1940s and when this data begins, for the ratio chart, we've been in a declining ratio environment. What that means is that producer prices have gone down more than consumer price over time. Think of more abundancy. Think of better technology to produce items. Think of potential manipulation in the numbers. All of those things combined. We put a huge double bottom here in 2000 and in 2020. A big double bottom in this, and we've got a neckline that is up here. What I did is I projected the neckline to the bottom of this double bottom and projected it on top of that. And we could go to 1.14. From the 2020 bottom all the way up to 1.14, that is a monster move. We're talking 0.72 all the way up to 1.14. The 1970 to early 1970s, that was a move of 0.93 to 1.12. What this is suggesting is that we are going to see a monster move from this ratio, potentially. I'm not saying it will 100% be in the bag, but potentially. We could see producer price index vastly outperform consumer price index in a very inflationary wave. A more inflationary wave than what we've seen in the 1970s even. Something that people I don't think are going to be used to. And if we break out of all this, we may be forever in that type of scenario where maybe we move from a world of abundancy to a world of scarcity. And I don't think people have their mind wrapped around that. But that's how I read this chart and what this chart may be suggesting over time. Abundancy to scarcity. We've got uranium spot here. I've got the rising wedge that we were talking about, and then the big middle finger of this thing just rip into the upside, basically stating that we've got perhaps more upside left in this tank. Coming down, we've got, I talked about that one already. Now, here's another one. Oil's breaking out. No, that is not very deflationary. As said for years now, this commodity bull is a lifetime opportunity. Totally agree. This is WTIC divided by US oil on the daily, and it's starting to break on this ratio. I know it came back a little bit, but this is a falling wedge. It's ready to bust to the upside in any second here. We got a little bit of a false breakout, which is that slingshot to the upside. I think that this is going to be the driver of that inflation that we see in this chart up here. That's what's coming. It's going to be a big move in oil. And uranium's going to go up. I get it, but we're going to see a big, nice little move. Big, nice little move. You like that in oil, I think. Another one, silver. He's got just a nice little trend line that's ready to break at any second here. This chart stands out as one of the most bullish setups for the next 5 to 10 years. I also think oil's got an incredibly bullish setup. All of these, gold, silver, platinum, oil, nat gas, uranium. They all ridiculous setups here. He says the inevitable breakout from this historical resistance is the primary reason for our strategic focus on deploying capital efficiently into high quality projects with substantial exposure to silver. Yeah, it looks fantastic, guys. Absolutely fantastic. Historic wave of LNG projects begins this year. It took half a century for the energy industry to develop the first several 100 million tons of LNG export capacity. Now the industry has potential to do it again in the next 6 years in terms of LNG capacity growth. Big growth coming ahead of us. I've got major investments in this, basically providing the natural gas for this LNG capacity. I think it's going to be hopefully a very big move in natural gas. And then that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for content, subscribe to the channel, and we'll catch you guys Sunday if you're a platinum member for our community. We'll do the question and answer session at 5 p.m. and we'll catch you there. And that's what I've got for today. See you later. This is Finding Value.